Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? Phil Tarrant, co-host of Property Investing Insights with the Right Property Group. The team's all in the studio. Myself, Reshmi and Phil Kumar. Gang, how you going? Welcome back.
Good.
I see that, you're scrimping on the budget. There's no coffee here today.
I know. I saw that. I'm actually drinking cans of Boss coffee these days.
Are you?
Oh.
Yeah.
Boxed coffee?
Boss.
Oh,
You know,
Boss coffee.
It's a black coffee in a can. You buy it from the
Boss is
supermarket.
always black.
Yeah. Yeah, Boss coffee is the way forward.
Yeah.
So, no, I do apologise. I'll give the feedback to management. There's no coffee.
I
Are you
know.
upset? Are you?
No, I just know that, you've got really deep pockets, but very short arms.
Oh, God, I think it's the other way around. I've got really long arms and very short pockets. It feels like that at the moment. I'm not able to get into the market as quickly as I'd like to, Victor. What's going wrong? It's your fault.
there's
You're buying too
plenty-
many properties. You're wrecking
Yeah.
it for us.
I know. And there's plenty of buyers in the market and not enough properties. As usual, not enough good properties. And, of course, there's quite a few buyers agents in the market, and especially at this time of the year, where everyone's jumping in trying to catch up with the goals, and then when you flip into 1st of July, they talk to the accountant. Yet more people enter the market.
So people are meeting with their accountants because it's the end of the financial year, and the accountant will be saying you need to be doing something.
Yeah, a bit too late now.
Too late
This financial year.
for the next financial year. But accountants aren't still making those recommendations for the purpose of negative gearing, though, are they?
Oh, wow. The jury's still out there.
Okay.
Yeah. Although I must say that there is a definite shift towards, more business accounting in the sense of, let's build up a portfolio.
Yeah.
Let's look at multiple property ownership. Whereas when we started, we had to actually educate the accountants first.
They're going, well, you can't do that. No, well, what are you doing?
Yeah.
You're mad.
Yeah, I remember one of our accountants, he sat me down and gave me a stern lecture to say, you've got to stop buying property because, you're buying too many.
On what basis, though? You're going to go broke? Or it's too risky?
Apparently.
Okay.
Apparently.
What did you say to him? Okay.
No, I didn't say anything. I just changed accountants.
Yeah.
This is the accountant who said, I can't do your business anymore.
Yes.
Oh, really?
I
Was
won't
it?
be-
It's
Yeah.
too messy. You're buying too many properties too soon.
Yeah.
Oh, there you go. And this is, and we speak about it sometimes, outgrowing your advisors.
Yes.
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 That would be probably a key tell that maybe you've outgrown them.
Yeah, definitely have.
But you obviously didn't listen to this wisdom and stop everything.
See, you've got to first of all understand where the advice is coming from before you heed to the advice.
But they're giving you that advice with the best intent. They thought it was.
They thought they were doing the right thing. Yeah, no, absolutely. Yeah.
There you go.
Mm.
Wow. Property's forgiving, thankfully.
It is. Over time it is.
Over time it is.
But not every single property is forgiving. I mean, look at our Salamander Bay units, right?
We've spoken about that.
Yeah, I know.
That was your dream holiday home, wasn't it?
Absolutely. We've used it probably a little bit more this time around. But, I think probably stayed there for 10 times since we owned it 15 years ago.
Salamander Bay, Nelson Bay.
Nelson
Yeah.
Bay, yeah.
Nice part of the world.
It is a nice part.
So
of the
it
world.
was a dream we bought.
Yeah.
We bought the dream that we will be going with our friends and enjoying our time away from home with friends. And we did that after buying the property. We did that maybe about
10 years
15
later.
years.
Yeah, 10 years
10
later.
years later? Yeah. Okay.
Wasn't this the dream?
Oh, no.
Podcasting with Victor?
Maybe another time.
More like a nightmare.
Yeah, God. Everyone's got a Salamander Bay tucked away somewhere.
Yes.
Yeah.
You
Yes.
need it just to
Yeah.
just remind you of what's going on. But you made a point there around the time of the year, and there's a lot more people out there, and there'll be a lot more people coming to the market, a lot more buyers agents. I was chatting with someone the other day, and a buyer's agent, and they're saying that essentially the way that they originate a lot of their business now is other buyers agents who aren't able to essentially
Complete.
build a business. They just are out there finding assets for them. And then that's the extent of what they do because they can't build businesses. They don't know how to build business, which I think there's probably a lot of relevance to it, right?
Well, it's a new industry, right? So there's a lot of new players without the experience and perhaps without the right training, both to own businesses and to also source properties.
True.
So and there's nothing wrong with that, right? This is a fledgling industry, so it will actually happen that way.
Yeah.
We just need to pick who you resonate with and stick with them.
Well, you've been doing it for 20 years.
A little bit more than that, yes.
20 years, 25 years. About 2000 you
Yeah.
kicked off. We know the story. You know the story. Hence the reason why when we talk about designing your decade, which has been the theme of the last this the sixth installment of this special series we're doing on Design Your Decade, you actually can talk about multiple decades in and around property.
Yeah.
You've seen it all.
That's it. Yeah. Made all the mistakes.
Is there anything you haven't seen?
Not yet.
No.
Yeah, but it might be there that we haven't seen. Something
What about
new
AI? Is that the next big thing for is the AI machine going to take your job, Victor?
No. And I can say that with conviction. And we did talk about the biggest opportunity and the biggest threat earlier this year when we started the podcast, that AI is the biggest threat to investors, in the sense that, so what AI is doing is taking human intelligence and putting it on steroids. Yeah. But it can't take in the human element. And so when you look at people that are just totally focused on AI and buying using just AI, it leads them everywhere. But the on-ground truth and the nuances that you understand over years of doing this doesn't factor into that. And that's why everyone ends up buying in the same areas as well.
Yeah, and I'm thinking about a particular location now. I won't mention it, where I think a lot of that is taking place. But it's a big deal, right? You know, you can't. Yeah, I guess the good thing about doing what you do for a living is it's a service. But yes, AI can probably augment how you do it.
Yes, it does help.
But still, you still need a human to interrogate the asset. But you know, again, like, will AI ever get smart enough to work that out?
Perhaps, but not right now. I equate AI to riding a bike. So you need to first learn how to ride a bike and be good at it, and AI then becomes the electric bike. Just gets you there faster.
Yeah, I'm just going to put something into just while I'm talking into AI right now, just to see where it tells us.
Are you putting? Is Victor telling the truth about AI? Are you a threat?
Where is the best place in Australia to buy an investment property? See how generic the response is.
Are you using ChatGPT?
I'm using a different tool.
Okay.
Something that we've actually created that we will release at some point. But it's still pretty early doors on it all. But it'd be interesting to see. Let's have a look at. Here we go. Here we go. This is what AI is telling us. Melbourne. Despite its poor market conditions, Melbourne is seen by some investors offering excellent future capital growth potential, mainly due to its population growth and economic significance. Okay, that's actually got a site. Perth, it has been highlighted for its booming property market, moderate rental firms, which have attracted many investors. Sentiment towards Perth is very positive. Okay. Brisbane. This has actually used the source of one of our stuff. That must be fake news. Brisbane, Gold Coast and Sunshine Coast. These areas benefit from significant internal migration and infrastructure development, contributing to a healthy economic growth. Again, smart property has been quoted all over there. Wow. Greater Sydney, although there are affordable issues, Sydney still offers strong opportunities due to its substantial economic output and ongoing infrastructure projects. However, growth is expected to slow slightly. Adelaide, known for its vibrant economy and balanced affordability, Adelaide is blah, 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 and Tasmania, specifically Hobart.
So it doesn't really do much. It's just a eeny, meeny, miny, mo, whichever one you want to
It's just
go
told
with,
you.
right?
It's just gone. It's gone pretty much anywhere.
Yeah.
Like,
So it's crowd. You could say it's crowdsourced in the sense that if there's lots of articles about Melbourne, it'll say Melbourne.
It'll say Melbourne.
Yeah.
Yeah.
And-
Technically correct, but the nuances aren't there.
and therein lies the danger that you're alluding
absolutely.
I think John Lindemann came out with his newsletter today, or was it yesterday? And he was mentioning AI and how that's going to be a big threat, and people will get financially hurt if they don't take into account the human element.
Yeah, I completely subscribe to that point. Hence the reason why we have mortgage brokers and buyers agents and really capable accountants. Now, I think AI can go a long way to supporting how they conduct and operate their businesses. But I remember I spent some time in San Francisco some time ago and meeting with the futurists from Salesforce, and we're talking about the future of financial advice largely. And I'd certainly put, not that it should be bundled into, but I would say buyer's agency would be fall into that bucket. And they said that technologies are going to change the world, and now you would throw AI into that for how these people operate. What will change is that it will change the work that they do, where they'll be spending more time as professionals, being better skilled at their craft and being knowledgeable around it to provide better advice to their clients.
So one of the things we do at Right Property Group now, there's a definite tilt towards most agencies using AI, right? What we do differently is we first find the area, then we use AI and we use data to validate what we are seeing on the ground, right? So we're doing it in reverse. Now, it's clunky doing it that way, but it's much more safer financially because you then putting the human element first and then supporting it with data rather than the other way around. Because once you've got data, you tend to be biased.
You're instantly biased as soon as you have data, because what do you do with data? You form an opinion off it, right?
Yep.
Yeah.
And that's the danger around it. I guess into the future, is there going to be all properties transacted for property investors using AI, even in a negotiation? So some AI agent negotiating with another AI agent to determine the best price for a deal, like very utopian. But this is where we're at. But you still need to design your decade, and that's a very emotive thing. An AI machine can't get into the minds of an investor, Reshmi, to actually, tell you what you should be doing.
Everyone's life's different, so everyone's scenario is different. So AI can't predict what's going on in your life and map it out for you. So there you go.
It's very, very challenging. And this being the 6th installment of our special series on Design Your Decade, and we've spoken about exit strategies. We've talked about age-appropriate investing, which is good, and age being a state as well as a maturity level as well as an actual functional age. We spoke about the 4 Ds. Victor, what were they again? Put me on the spot.
You're going to put me on the spot again, right? So there is
that's
debt.
my job.
There is diversification.
Yeah.
There is defense. And what was the 4th one? Was
the third one. There's direction. And
Direction.
there's
Yeah.
That's what he loves, direction.
Yeah, no.
Yeah, that's right.
That's why I've got Reshmi here.
Yeah. We actually got something credible, most credible person in the studio, Reshmi.
Okay.
But how long? So you're now sort of really inside the Right Property Group business, driving forward a lot of its growth and its evolution. Are you really enjoying the work?
I do. I love it because I've got the flexibility and the freedom to take it whichever way I want, and I've got the freedom to look into everything that goes on, and processes are one thing, and to make sure all the processes are good so you can support clients properly. So implementing changes, looking at overall how everything goes, that's like really lovely because I love doing that. So
and this is the important bits, right? Like Victor's out there sort of doing all the glamorous, looking at properties and doing deals, but the reality of the world.
I'm doing a lot of the work behind the scenes. Let's say. I'm not really.
She always has been.
Yeah.
I always have been with all the stuff as far as the social media goes, or anything to do with the marketing goes, anything to do with supporting the clients. Even the education. I mean, like, remember, Right on Track was my thing. Like, I know you guys were doing it for a long time, but I put that in place 25 years ago.
25 years ago.
Yeah, and I was only in my 20s myself. I think so. Yeah.
And I know the Right Property Group team pretty well. I've known many of them for as long as I've been investing. They're a very talented sort of group of people. But I've got to pick you up on this because I haven't spoken to you since I got a note from you. I'm sort of involved in some internal bullying, I would say, inside of the Right Property Group office.
Okay.
Which I don't know if I should be party to this sort of stuff.
Okay.
I think I might want to speak to HR.
I think
Are you HR? Can be HR.
I can be HR, but no, I'm not. Kate is HR. Any HR goes to Kate. Yeah, that's it.
So just to put it in context to the listeners, one of our staff members put together one of those AI generated toy pack or whatever they call it, the kit, and it had me there, it had Phil, and I think in one of the takeaways in there it said podcast with a sprinkle of banter.
Yeah, something like that. Can you actually get them made? I'd like to see
We have
figurine.
actually, yeah, we
can
had.
actually put them up on the shelf here. Would be quite funny.
Well, that's a challenge. Yeah, we'll take that on.
Yeah. See if you get an actual figurine. You get your SPI Phil Tarrant figurine collector's item. It's a bit like a Star Wars Wookiee.
That's our merch.
Still in its pack, right?
That's
and give about it things, but it's quite good fun. So, sixth installment of Design Your Decade, and we've sort of gone deep into all those different aspects of investing. I really enjoy it, and one of the sort of takeaways for me is that I get to sit down with people like Victor and Reshmi, and I interrogate these discussions with a lens towards how I'm doing things as well. So it's a good way for me to reflect and recap, and again, this is always a balancing item for me when I speak with you guys, that I go, I'm not doing enough, and I always tell you I'm going to do more, but I'm never going around it. And anyway, we'll work that out. But so we're actually going to be talking about investing strategies, which is pretty important, right? So this is the doing of the investing.
Absolutely.
So this is the identifying locations, finding assets, negotiating assets, and there's not one linear way for doing that, I would imagine.
No, there isn't, right? So what we've done over the last 6 episodes is put the framework in place, and now this is time to then think of, okay, where does this head? So we talked about your mindset and fixing that first. We talked about finances. We talked about a whole lot of things that we need to do pre getting into purchasing properties. Whereas what happens most times is that people get the bug, or they get the advice to go buy a property, and they jump straight in without doing the training, without doing the groundwork to make sure that it comes off as a substantial start, and it comes off as a sustained start, so that you're not just buying one property. You're not buying a salamander bay, right? So you're not buying something that's going to take you backwards. It's actually going to take you forwards, take into account the age, your finances, your ability to weather the negative cash flow storm that comes in any portfolio, and also keeping you safe from all of the noise that's out there about, hey, look at me, I've got 10 properties, or look at me, I've got 50 million worth of portfolio. To me, that's just a barbecue brag. We really need to bring it down to your own personal level to see what you're trying to achieve. And I'll spill the beans now, right? So
I'm not sure what you were going to say, but just remembering the email that
yes,
we received
yes,
today,
that's right.
yesterday,
yeah.
about this exactly.
Oh, okay. So people are actually listening to this.
Yeah. So they actually
who would have
listening.
thought?
Yeah, I think they skip past the bit where you talk.
Yeah, probably.
Yeah. So big shout out.
I remember again going back to when you guys. It seems to be a theme of being picked on by the team over at Right Property Group. I remember when we used to record this with our good friend Steve Waters. He used to mock me and used to play the podcast back in half speed.
Half speed, that's it. Yeah.
And just go, look at him, he's a stoner, Anyway, so people do listen.
Yeah, people do listen. And a big shout out to Matt. Thanks for sending that email. Very well received. And what Matt was saying that, he's listened to and followed a lot of Facebook ads and all that. And Matt's a client. And he said it just brings it back to reality in terms of what should and shouldn't be done, and that this is a game of patience. It's not a game of how quickly you can accumulate. Yes, that is important, but that's not the first thing that we look at. It's keeping yourself safe, right? So, like I said, I'm going to spill the beans up front in terms of strategies. There are really only 3 strategies, right? And you can go the sedate way of simple buy and holds, and there's nuances in there. You can go the path of build and balance out the cash flow, so a little bit of pigeon pairing in there. And then the third way is more your generational investing, which is where you are plugging in your development type properties, your commercial properties, and you're building them in pods, so in silos as such, right? So
I was thinking that's where you're going, in the pods.
Yeah.
And then the pods itself, like you can have multiple pods. So we'll come to that after discussing the first few.
Yeah.
Pods being collectives of...
Pods or silos. Collective
and that might
properties.
be a philosophical thing, but also structural. So you might have pods in a trust,
Mm-hmm.
which serves a purpose.
Mm-hmm.
Okay, that sounds really, really detailed. So I'll pick up your point around patience, and was it Matt that was it Matt that wrote in? Thank you, Matt. Yeah, I sometimes use the term, and it's really shaped my investment strategy, but just my overall strategy in general for how I do most things, and I've always been this way, is strategic patience.
Yeah.
I call it strategic patience. It's hard to get, if you think about property investing, for example, it's hard to get wealthy really quickly in property unless you
This is a get-rich slow scheme, not
Yeah.
a get-rich-quick scheme.
Yeah, and get rich slowly is okay as a property investment thing, right? If you want to get rich faster, well, you can do that in parallel with getting rich slow in property. You can do other stuff, right? And give it a bit of risk. But most Australians, inverted commas, just to generalise, should really embrace the idea of strategic patience, because that is realistic and it's accessible and it's meaningful for most people.
Yeah.
If you've got other ideas maybe above that station, you're probably going to fail and it's not going to work out. So be comfortable with the idea of strategic patience.
Yeah, resilience is another one, which is
Absolutely.
Yeah.
These things don't happen easily.
No, because as you go through this process, it's going to test you, right? Both from your debt paradigm and also from just life itself.
Yeah. Yeah. So be uncomfortable.
Yeah.
Being uncomfortable, right? That's a mindset thing. Hence the reason why we've talked about beforehand building buffers in place. So irrespective of what happens, you can still, maybe retreat to where you need to be and you can take stock and reset and recalibrate and you can move on from there. But let's talk about the first strategy here, which you've said is sedate. That's probably, most aligned with this notion of strategic patience, right?
Yep.
And the idea also of strategic patience is that you still got to make good decisions along the way. It just takes time.
It does take time.
Takes that. So talk me through sedate, buy and hold.
Okay, so I need to take a step back in terms of if we look at what the stats are in terms of property ownership, investment property ownership, and there's circa 2 million that own investments in Australia. Of that, 70% own one property. And then it filters down to there's only 35,000 people that own 6+ properties, right? So when you're talking the pod system, which is the advanced end, that's where you're graduating towards, right? But you've got to start from where everyone's starting, which is be in the 70%, get property ownership, learn how to say no to the property manager, learn how to make decisions before you step on to the next one. So if I bring it back to our Australian education system, you got primary school, and perhaps as you're preparing, it's kindergarten, right? Primary school, then you've got secondary, and then when you're in the advanced strategies, you are in the university or TAFE, depending on your cash flow and depending on how dialed in you are into the portfolio.
I don't mind that as logic. You got to start somewhere.
Yeah.
But for most Australian investors, where you start is where you end. If
That's
it's
true.
only,
that is very true. Yeah.
if 70% only own one property. So, but again, it's a frame of reference. You need to put things into perspective, and most people that enter property investment, the reality is you're going to own. Most likely, you're only going to have one asset.
Correct. Yeah. Unless it's planned out, and you're planning your decade, then you are definitely going to be at least in the second phase.
Yes.
Which is your 12-18% of your cohort that own more than say 3 properties. And it comes back to the education process. It comes back to again, taking a strategic approach, being patient. And if you recall back, Reshmi, in the olden days that everyone was saying to buy 10 properties, sell half, and
that used to be a strategy for a long, long time ago. When we'd go to any seminar, that's what they were saying. So you could buy 10 and sell 5 and keep the other 5.
Retire the debt.
And that is, if you wanted to do it that way, yes, it takes you a long time to get there.
And it actually doesn't work right now.
That again, the
prices
don't allow for that. The market now doesn't allow for that strategy to be executed very well.
Would that be more of your buy and balance type?
It would be, right. So if we look at 15 years ago, right, the houses that we were buying that we are buying today at say 650, 700, we're picking them up for 150, 250. And so the requirement for capital was far less. The cash flows were better. Even though the rates were high, the cash flow was better at that time, purely because of the debt and
Debt to
rent
income
coming
ratio,
in. And so it was an easier strategy to do, right? Whereas now, if you did the same thing, you need a whole lot more capital. There's a bigger gap between money coming in, money going out. And of course, we now have compliance. We have all of these extra bits and pieces within the property ownership. That's changed. Now, and for the better as well in terms of compliance. But we need to take into account that the tide has shifted a bit, right? So we need to, just like when you're on a beach having a picnic, the lifeguards do move the flags when the waves shift, when the rip shifts, and it's the same with property investing, right? So we have moved the flag where it may not be possible to buy quality properties, 10 quality properties, and then sell half and buy down half. We may have to come back and tinker with the properties, and hence the other two strategies that come in there.
So this idea of you 15 years ago, for example, 20 years ago, buy 10 properties, hold on to them for 20 or 30 years. During that period of time, you would have paid off either the debt across all of them if they've shifted to P&I and you haven't refinanced them, and or you need to sell some of them in order to paying the debt off the other ones, right? So functionally, that's very hard to do now because
because buy of the capital requirement.
Because to buy 10 properties, now you need a huge amount of capital, and there's a real imbalance compared to maybe how it was 15 years ago of what people earn versus what properties are worth.
True.
So structurally, it's a lot harder to do.
Yeah. And we're talking about buying them in a short period of time, right?
Yeah.
Of course, if you gave yourself enough time, you would be able to buy 10.
Yeah, but buying 10 in 5 years is probably a little bit harder these days. Unless you're really...
the 10 years, one a year would be fine. And by the time you go to another 10 years of your life, then you would look at your first ever one that you bought. Yes, definitely it has got 20 years worth of growth. So then you could just sell one or two and get rid of the debt on the others, or you could decide. But that we found was a very simple, laid-back way of doing it. And I think a lot of people, if I go back to your question, the statement you made, like one property and that's the end, most people know that they've got to buy, and so that's why they bought. But they're not investing.
Because their accountant told them to.
Yeah, somebody told them, but they're not understanding the actual investment side of things to say, okay, I bought one, but I know that I've got to buy. I bought one, but why did they buy that? And what else can they do? Because they just know to buy a property and they bought. And that's why there's a lot of people who've just bought property, but then that's it. They're not investors, or they don't surround themselves with educated people, let's say, or they're not in that zone because they're everyday people living and got a property, and that's the majority.
And there's nothing wrong with that.
There's nothing wrong with that. It's just that if they did a couple more strategies, they could retire the debt on that property far sooner, and they could have a better access to the income much faster.
I'd like to see overlays. It's an interesting point, Reshmi, and it doesn't go this granular, but I'd really like to see this idea of, you've got these three different strategies, right? If you actually went, let's start splitting property investors into PAYG versus
business
self-employed.
Yep.
I would think that self-employed people, as a percentage, would own more properties than PAYG people.
On our database, no, it's pretty much equal.
Is it?
Yeah.
Yeah.
Now
find that surprising.
We do have a lot of people that do fall off the habit of building their portfolio. That's different from buying property.
Yeah.
Purely because they have stopped educating themselves, right? So in the initial stages, they were it was a new thing. They were giving all their energy to it, and they were seeing the results. And then normal human nature takes over, where you've got a bit of result on your table. You don't want to risk it, right? So they stop. So if you bought a couple of properties and you just simply left it alone, and you operated off the original purchase LVR, as soon as you hit 70% of the original purchase LVR, so not the value now, but the original purchase, your property actually flicks into positive under current interest rates.
70% of the original purchase price.
Yep. Provided it's interest only. Yeah. Now we are assuming over here that the yield is decent. We are assuming here that the repair bills are not extraordinary. Like right now in our portfolio, we're going through huge repair bills with our roofs in Brisbane.
Yeah, I got some of that. Yeah.
And a few in Melbourne as well.
See how much a roof is in Brisbane?
I've just paid 76,000 for.
Yeah,
but mind you, it was a small complex.
Yeah,
so,
I got a bill for 100 to do a block.
Yeah, it's not onerous. That's about the right one for your block. But if you can get a few more years without spending that money.
I just went, mate, get some blokes up there with a silicon gun. Silicon it up. Don't worry about it. It's fine.
Yeah. No, but so back to your question in terms of there'd be more self-employed people that own more properties in comparison to PAYG. It does come back to the income that's coming in. So we've got people that have got very high income as PAYG. We've also got people with 60,000 in income, right? The portfolios would look different. The numbers would look very, very different because the slippage between money coming in, money going out, and the ability to tolerate negative cash flow certainly is far better at the higher income earners.
What do you sort of count as a high income for PAYG people? Like you look at your
300 plus.
So you say it's a high income, 300,000 plus.
Yes.
So if you're earning that sort of dough, so if you're at 300,000, you'd probably find people probably spend most of that.
They do
because they've got
spend
very
a lot,
expensive
right?
lives, right?
Yeah, they've got expensive homes and all. So there is a little bit of education that happens there, and we do have clients that are owning more properties than the higher income earners, but they are very low income earners.
Would surprise me.
Yeah. Properties do look different though.
Yeah, I'm sure they do, but that would be a lot of the things around mindsets and all that sort of stuff. So this idea of this sedate strategy, you need to start somewhere. So imagine that's where you start, one or two, and then typically you stop, you fall off the pathway, and you just become one of the 70%ers.
Yeah,
that's okay.
Yeah,
it
is okay. At least you've got one or two, right?
Yeah. So pulling it apart also. So I would have thought you would have had a split. There would have been a split in property ownership, PAYG versus self-employed, and I would have thought a lot of that would have been around mindset. Like self-employed people are probably more comfortable with the idea of some of the mechanics and risks associated with property investment versus PAYG. But
I think because regardless of who they are, because we've always based our business from education point of view, the education has seen that no matter what type of work you do, they've got the same education. So they're following our process, and so no matter where their income comes from, because they're following our process, that's why we haven't got a disparity in the numbers. So
that's encouraging. It's encouraging
very much.
to hear. Yeah. So you've got to start somewhere. So 1 to 2 properties, and typically there'll be something will happen that will accelerate someone from that into something which is more significant, which is a build and balance type scenario, which most investors go through at a point in time before they graduate, to use this sort of schooling analogy, into building up more generational assets. How do you get this first strategy right, though, and how do you sort of temper expectations of your clients, or Reshmi, how do you temper your own expectations to go, one's enough, two's enough? And again, pulling it apart, I'd like to know those people that own 70% of they own one property. I'd like to know what sort of properties they are. I reckon there's probably a lot of properties that don't provide accelerated capital growth for people. There'd be a lot of people who maybe want to graduate out of one property into more, but the property they bought is the wrong one.
Yeah.
Those people probably come to you to fix problems, but I reckon there would be quite a lot of that.
The ones who've got one property, mostly people buy a property which is similar to their home or within the suburb or somewhere what they know. So it's similar to what they live in, and that's that type of property. But with our clients, I guess, you saying expectations. So the first thing is, like, when you're starting, you've got to buy one. So taking you back to the beginning of your journey, basically that would be, what can you afford? What is your age right now? What does life look like in the short term, in the long term? So all of that will determine what type of property they will be buying now.
Yeah.
Because if someone's in their 20s, they could buy a set and forget and come back to it later because they want to enjoy life or whatever else they want to do, and not seriously thinking about really getting into investing. They want to live life, and maybe they'll come back in 30 years time when they're 30 or 40. And so that's when they can go serious about it, and then they have got that property that they bought 10, 20 years ago as a foundation to pull from and go, however fast or however slow they want to go.
So when do you know it's time to graduate out of being in this sort of buy and hold type sedate strategy into sort of build and balance? What typically is the driver, Vic?
So we do have this review process. So when we sit down with the clients, we review what's happening, what's happening in the career and what's happening within the portfolio to then judge their risk appetite and their actual risk in terms of adding more to the portfolio. So there are quite a few people that actually say, no, you shouldn't be buying because you've got new family addition coming up and whatnot, or you're just changing jobs, where there are others where I'll turn around and say, well, we need to accelerate. It comes back to the goals, right? So usually when anyone's starting, the goals are fairly intangible because it's so far out in the future. And really we can only plan 18 months in advance in most cases. So once 18 months comes through, they've said, oh, this is fairly easy. We can add to this. And it's like a building block. And we're slowly getting towards the goal that becomes more clearer and clearer. So it is, again, mapped out based on their requirements as opposed to a set and forget, hard-channeled process. It meanders with their life, still keeping them focused on their goal. So trigger points could be that they're about to start a family, right? And they may want to square one more away at the time. Or another trigger point could be that, well, kids are now out of school. I've now freed up that money. Let's put that back into property in terms of holding cost. So there are different trigger points that happen, that then gets dialed into the journey to make sure that we are tracking towards the goal. And spoiler alert, the goals do change. As life changes, the goals do change.
Who would have thought? How many people do you know started on a property investment strategy 15 years ago and are still on the same strategy?
I know.
Yeah, I don't know if it exists, right?
Yep.
No. Numbers always change and attitudes it's changed. And, fortunately now there's so much information out there to accelerate people's mindset out of being the 70% into, I think the number sort of jumps to about 80 or 85% if it's between 1 and 2 properties, right? Like, so there's only 35,000.
Yeah.
So would that be individuals, or is that people investing in trusts? Like, again, you never can really get to the bottom of the
We can never get to that point.
No.
I think, and this is one of the reasons why the stat is always 2 years delayed, is I do think it actually involves tax-paying entities rather than individuals.
Yeah.
Because if it were not the case, then our stats would be 1 year delayed. So that ties back into when people put their tax returns in, right?
Yeah.
Most self-employed people and trusts, they can be almost 2 years before they put their returns in.
Yeah. Is that you? You always lazy?
No comment.
No comment.
I refuse to answer the question on grounds that it may incriminate
but
me.
again, that's often, and this is when you want to get to the real graduation, generational stuff. Like, these are some of the strategies you need to have in place. No one really talks about is actually when do you lodge your tax returns.
That's right.
Sometimes you go, well, I'll lodge it straight away because
you need to qualify for finance.
I don't want to provide those financials yet because I'm quite happy with. If the bank's still taking previous financials, I'll just do that, right?
Yeah.
Like, it gets really strategic.
That's right. And the strategy is not only on the purchase side of it, right? So along with the strategy we put in terms of purchase, we also then need to put a parallel strategy in terms of finance, right? Because sometimes it may be that we need to go back and rejig the property itself, build a granny flat as an example, or change that loan back into interest only to then qualify for the next loan, and also to create the money to hold on to the next negative cash flow property.
And this is when you would be graduating the build and balance when you start talking about granny flat.
Correct.
I've never done a granny flat. Never.
I know. We came close in Mikoba.
I think I've just is anyone there? I can't hear. Is my
You can't hear?
No. Hang on. That's probably the reason why.
Oh,
Yep. Yeah,
good?
that's me.
Yeah, so we came close to building a granny
Yeah, you
flat in
tried
the
to convince me
portfolio.
a couple
Yeah, I
of
know.
times, and
Yeah,
I've
yeah.
just always gone, I just
Too much hassle.
too much hassle.
Yeah, you make too much money, Phil. That's what the
Is
problem
that what the problem is?
that's
Is
what
it?
the problem is. Yeah. Or your portfolio is well rounded and it doesn't cause you any cash flow issues.
Well, I was always satisfied with the cash flow issues. I was
Let
able
me put it this way.
Yeah.
If you had built that granny flat, there would be one less person out there looking for a property to live in.
So it's my civic duty, do you think,
Yes.
to be building
Absolutely.
that? I've let astray down
That's
by not manufacturing. But I've always been reluctant because I've always gone, like, what do you need for a granny flat? 100 or back when we were
Back
doing
then
this, it
it
would
was
be about 80,
150, yeah.
150 now or whatever. So you'd have to finance that or you'd refinance and use it and do it with cash, and it would just change the cash flow position. But I was always satisfied
Yeah.
with
I
the negative cash
want
flow.
to unpick your brain on that,
Sure.
actually. Oh, my God. There we go.
Yeah.
What was the thought process on what just didn't make you? Is
Largely, I couldn't be bothered.
Is it like the project management side of things that you
It was. I was of the thought that the juice wasn't worth the squeeze, and we thought about doing it a couple of times purely to do it as a story, right?
Yeah,
On the smart property investment portfolio, and I'd get there and look at it, and I'd go, well, if I'm going to deploy that capital, I'd rather allocate it to
something
another asset rather
Okay.
than doubling down. Like
Yeah.
there wasn't a problem with serviceability. There wasn't a problem with the negative cash flow. So I was happy just to wear it. And obviously there's tax upsides with the negative cash flow, and it's about balancing, right? You can balance out those things elsewhere. So
It
Yeah,
just
so-
opens that door to that important bit about strategy and how it needs to be dialed into the person, right? You didn't need to build a granny flat.
No.
Yeah.
didn't need it. You wouldn't do granny flats now.
I
would you?
do granny flats. I love the depreciation on them. And
There's another thing,
yeah.
right? So there is tax upsides
Yes,
by
there is, yeah.
doing
Yeah.
depreciations. But it does get to a point. We're chatting about this beforehand.
Yeah.
You should do things for the purpose of taxes and outcomes, not a strategy. However, you can get to the point where you've got your depreciation benefits outweigh any of the utility of those
Correct.
depreciation assets. So there's no use. It becomes a nuisance.
It does.
Any strategy I think you deploy on the properties themselves has to be in line with what is your overall strategy. What are you trying to achieve? And if it's meeting that goal, only then you go and deploy those strategies with the property. So
It's
yeah.
good to have those
Optionality.
on those properties, but it doesn't mean you have to pull the trigger on them.
No, you don't. And you can preserve depreciation for future years and all this. Again, it starts getting quite complicated. But but the build and balance strategy that can last
It can last,
a decade, right?
Absolutely.
And it's quite hands on. You've got tinkering all the time.
Yeah.
right?
Do you want to share the Dapto story or
Yeah,
in the Rud
Dapto.
Road?
You know, Dapto's in the Fast 50
Is
this
it?
year. Yeah.
Yeah. I've been
Only
buying
this
there.
year. Okay.
I've been buying there forever.
And Rud Road, remember when we got that? So this is those strategies, and we had these properties with the opportunities, but we didn't come to them for
10 years.
yeah.
Yeah.
So
the Dapto property we had bought way back 12 years ago. And we
House.
fibre house, ex-housing commission, cost us 300K back then, 640 square block. And last year, or before last year, tail end of 2 years ago, we put a granny flat on it and a studio because zoning allowed us to do so.
Granny flat and
a studio, so 1 bedroom, so 2-bedroom granny flat and a 1-bedroom granny flat on it. So it's still got the house.
Are they adjoining or separate?
No,
separate.
separate. Yeah,
Really?
with their own
when you
accesses.
look at it,
yeah.
it's quite spaced out. It's not cramped. It's nice.
So a studio.
Yep.
So just a
It's a 1-bedroom granny flat.
Okay,
Yeah, so it's 40 square meters.
Okay. So is it actually bedroom in it,
it's
or the
an
bedroom
actual
is part
bedroom.
of
No,
it? Okay.
actual bedroom in it.
Yeah.
And we fully refurbed the house. We got rid of the fibre. We put cladding on
Cladded.
it. Yeah. So got rid of the fibre and then put cladding on it. So that's given it a whole new lease of life. And our cost to do that was the granny flats, the renovations, including sorting out the driveways and the fences and all that. That was 350K all up. So 300 original purchase price, 350 as a build. Our rent on that is $1,500 a week.
Okay.
Yeah, so it does make sense in that.
1,500 on establishment costs of 600 and whatever it is.
Yep.
Yeah.
Plus the depreciation.
Plus the depreciation. So you didn't do it for the purpose of depreciation?
No, I didn't. I did it for the because it was in an entity where I needed to tilt the entity into positive.
So tilting is
it's very important, right?
This is asset allocation talk, right?
Yes.
And you see fundies and asset managers talk about tilting stuff all the time. I'd ask you, why did you do that? Did you have to spend much time? Like you don't need to do that stuff.
No, I don't. No,
you don't need to be doing it.
But it is good to tinker, and people think that building something is going to take a lot of time. If you have a process, it doesn't take that much time. So I visited the site twice, only to do a video on it. But
who was project managing it for you?
The builder. Right, so
trusted builder. So this is build and balancing, right? You're balancing here. There's tilting.
Yes. Yeah, that's right. Yeah. So we gave the process to builder. We specified the quality, the colors, everything, and I stepped away. Right.
Was it a off the shelf type design? Did you give you option A?
No, we designed it.
We designed it. We designed it so that the whole site flowed. In terms of, okay, if it's a very slow rental market, will these properties still rent, right?
Yeah.
That's the key. And
so they are separate, they're private.
They are separate, yeah. So the reason why we did
600 and something square metres.
Yep, 680.
So it's not a big block.
It's not a big block, but the house is sitting right in front, so there's plenty of space on both sides. Yeah.
So it was right at the front,
Yeah. So we bought that knowing that at some point in time we could do something with this, right? And we checked access.
Chop it in half. You couldn't turn it into a duplex.
No. The shape of the block it's a little bit sort of wider at the back, and so it allowed. That's why it allowed us to put that extra dwelling there.
So the reason for doing that is if you look at the generational investing side of things, right? So it by building the two dwellings, we were able to tilt that group of properties, so not just Dapto, but the other properties that were in the same entity into new, it actually went into positive. Yeah.
Okay.
So now we can set that aside and forget about the entity, turn the loans into principal and interest, it'll do its thing in the background.
So it's positively geared at P&I level.
Yeah.
Okay.
So we're talking about the middle strategy, or we've gone
to
the
pod.
You've gone to the pod now.
But that's interesting. So you build and balancing, but then that will inherently potentially graduate into the next strategy, the generational strategy. So you need to do the build and balance before.
Correct. You need to wash out the negative cash flow first.
Yeah. So
to a large degree.
So did you deliberately glue together these assets in this entity? Imagine it's in a trust or something. Did you glue them specifically for the purpose of parking it in the future, or were you just sort of doing it and thought, I'll work it out later and fix it?
No, they're strategic. They're strategic purchase.
They're strategic.
That same answer. Luckily it's the same answer.
Yeah. Wow.
So if you don't mind, let's talk about this specific entity. So it's a trust. How many assets are in it?
5. You sure?
I think it's 5. Yes.
5. One of them is this Dapto place, and are the rest of the assets all in New South Wales, or are they different states?
No, different states.
So you've tilted it around that way.
Yeah.
Land tax.
So we're picking land tax, picking different cycles, because each state moves through different cycles. Each suburb moves through different cycles as well within the bigger cycle of the state. So asset-wise, there are a couple of units in there as well. 1 unit in there, and most of them are houses. Some have got subdivision potential as well. This one didn't have subdivision.
So therefore, it hasn't got subdivision potential. So you've milked it to generate as much cash flow. So how much of the heavy lifting of this sort of property, this asset you've created, offset the negatives in the other sides of the portfolio?
So it's then washed out all of the negative cash flow. So now we can set this entity aside and forget about it.
So eventually the other entities which are negative should naturally become positive over time.
Yes.
And then that will just generate positive
Correct.
income,
Yep.
which has to be distributed. You can't retain
That's right.
profits inside, so you've got to distribute it somewhere.
Yes.
So the way
Therein lies the problem.
therein lies the
right?
problem. So you got to you got to push it somewhere, and it'll be pushed to wherever the beneficial owner of the trust
Yeah.
is. And that's where you need to deal with.
True. Now, we can shelter a lot of that income. And again, this is getting a bit technical and
But
accounting
we're talking
side.
about like
Yeah.
the top end strategy here, right? Is where it starts getting technical.
That's right. So we can shelter a lot of that income through the depreciation, so we can absorb a lot of that income from there.
Okay.
That's how it doesn't need to all be distributed out. So we can stifle the flow of money out of that entity.
So this is
good
the,
accounting advice.
This
comes
is
into
the
play.
D in EBITDA.
Yes.
Yeah. Okay. So this is when it starts getting a lot more sophisticated. So
Mm-hmm.
earnings before interest, tax depreciation, and amortization.
Yeah.
I remember most
Yeah.
people won't have to go to that extent to be able to achieve what they want to achieve. Like this is very complex, and we've made it very complex because of some ridiculous goals that we had. So, but
Be careful what you wish for. Mate.
Yeah.
Like,
Yeah.
it's just if people actually know and they look at it, they go, "Oof."
Yeah.
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 Yeah. So, but the thing is though, is that you can distribute that money and then it's capital.
Yeah.
You can potentially use the profits out of this to offset other negative
You could other
entities
entities
if it's set
yes.
up the right way.
Correct.
You can move the money around.
Yes.
This is when you really, really good tax advice.
Yeah. So not only are we talking, purchasing strategy, we've talked finance strategy, but then also tax and income strategies as well.
Yeah.
Can I just go back one? This is something we've seen is where people are coming in wanting to invest, but starting putting together a trust and all the rest before they even have started investing. So, do you want to share?
Yeah. And look, for some people, it does absolutely make sense buying in a trust like yourself, Phil, right? So, whereas if you're just a simple PAYG, perhaps you may want to entertain buying in individual names first and then graduating into a trust.
Yeah.
There is that little sting in the tail when you come to retirement as to, okay, how is this going to be treated, capital gains tax-wise, income-wise and all that. But chances are you may not retain that property that long anyway.
Yeah. Yeah, and this is again the optionality of it all. You can create the best
Yeah.
ideal structure, but most people don't hold properties. Like, what's the average life of a mortgage? It's pretty low. The average, I think, it's 5-6 years.
5-6 years before they turn over.
Yeah,
Or
yeah.
through a sale.
So through a sale.
Yeah.
Yeah. So most people only hold on to a property. So the likelihood of having to pay tax on a property that you're acquiring today at a sell is pretty high.
Pretty high.
It's pretty high.
Unless you're on a strategic plan when you're using our services, where we do get you to sell down some properties, but with very good, we loop in the financial planner, the accountant, to actually talk about that eventuality.
Yeah.
And making sure that there is robust asset protection, robust retirement planning that happens right from the beginning. But it still comes down to, don't make it too complicated. Get the property in the best entity you can get the most money from,
Yeah.
and do it that way to begin with.
Yeah. It gets super complicated.
Yeah.
And we're only talking, well, you're saying 30 odd thousand people own, or entities own 6 or more properties. I imagine that's when you start getting inside of sort of trust-based
That's right.
scenarios. So we're talking handfuls of people comparative to the investors out there. So don't go too hard too early on creating a complex structure when the likelihood of needing to leverage it is low.
Yeah. Talk to your broker, talk to your accountant first.
Yeah. So that's a pretty simple construct then. If you've got a more sedate type strategy of buy, a build and balance, which where most people operate, everyone will go through that cycle. And you might be in 2 of these strategies at any given time. You could be, and I would say I'm in a build and balance cycle as well as the generational cycle simultaneously. They're running in absolute parallels, and things will graduate into it, like your story of like maneuvering that portfolio, maneuvering it into a generational asset. And I imagine generational, when you're talking about putting things into pods, you start thinking about cash flow smoothing. So buying commercial assets there as well. This is when it starts getting strategic, or even looking for upsides to manufacture greater equity in the future through developments, right?
The trick is not to buy the commercial too early. You need to be equity rich to buy commercial, because what a lot of people
Equity
don't-
rich or cash rich?
Both. Yeah, you need a sizable deposit, right? The deposit needs to come from somewhere, and so if we're harvesting the equity out of your residential portfolio, whether it is through refinances, which then has a cost that needs to be added to the commercial property, or whether it is sell down of a residential or some residential properties to pay the deposits across, then there is a capital gains tax event. So we need to plan all of those out. So don't buy the commercial too early, but commercial definitely has got a space in the portfolio.
And this is an aha moment for a lot of property investors as they go out through this cycle of build and balance to a more generational thing. If you start selling off properties in order to manufacture bigger deposits to graduate into the next strategy or the next sort of bucket of investing, there's a lot of costs connected with that.
Yes.
You've got to sell it, you've got to pay tax on it, you've got agents' fees, you've got everything connected with it. If you're refinancing, there's no tax consequence of, well, there's a second order tax consequence of it, but you don't, in order to extract money and build up a deposit, there's no direct tax connected with that.
No.
That thing where the tax comes into play, which can be an asset as well as a liability, is that if you're refinancing, it means your interest rates are higher on the properties that you've refinanced, and therefore you need to service a negative cash flow, which can give you maybe negative gearing. So it's much easier, if you can, through serviceability, again, to actually pull the money out to not sell. So that's what most people do. They max out the serviceability to a point where there is no more serviceability, and then you've got to start either doing granny flats to change things and or start selling down to keep
That's
going.
true.
Yes.
Yeah.
That's the challenge.
It is a challenge, right? So again, it needs to be mapped out in 18-month lots.
Yeah.
Because really you can't plan too far out. The overall plan is there, right? Okay, I'm going to get to this cash flow, these many years and all that. But then the shifts in terms of lending, shifts in terms of your affordability, all of those things need to play into it.
So would you always refinance before selling?
Not really.
No.
If you've got to sell, you've got to sell, right?
Yeah.
But there's some strategic sell downs.
Yeah.
There are others where the bottom line is that if you've held the property for couple of years, you may not be able to replace the asset of that quality at that price. It'll be definitely paying more.
So I appreciate, Reshmi, that you're probably the engineer behind the Kumar portfolio. So you're probably doing most of the tinkering here in the background, making sure all these things line up. You must be pretty satisfied with the portfolio you guys have built.
I love the portfolio we've built.
Yeah.
I am thrilled to see the portfolio we've built. And Chu wanted to share the number, what we were writing down.
Yeah.
God.
We were over the weekend. We just an idle conversation, like we chat on Sundays about property, right?
Yeah.
So that's our thing. And we had this idle chat about. Wonder how many flips we've done, how many properties we've bought and retained, and guess the number.
How many
Flips?
So how many times you've bought and sold?
And sold.
25,
we're
30?
talking, no, you're missing a zero.
Okay. Really?
Yes. And this is just to qualify this, right? And this is not something that I would advocate people do. Do as I say, not as I do. This is a result of almost 26, 27 years of investing. And along the way, to boost our cash flow, to boost our capital, we'd get into simple property trading. So we'd renovate, hold for a little while, sell.
Yeah.
Right? And the number is in the 200s.
That's a lot of transactions.
That's a lot of transactions.
That's a lot of
to the point where
variations
this morning, Reshmi woke up.
I woke up and I said, you know what, we forgot this one. And there was this one. And then there was this other one. So we forgot to add 3 more properties in there.
Is this recent or near recent? Like, you still doing it as much? Or?
Not as much. Yeah. Not as much.
That's a lot to buy, renovate, sell, or just buy and sell.
No, buy,
renovate, keep a little bit.
Some we didn't renovate.
Yeah.
Some we just mowed the lawn.
And how long? What's the shortest you've ever held a property? Yeah, I reckon you've bought properties and sold it before you've even before you've even settled on it.
The units in the beginning, which we did. Yeah. There were options and all that.
So advanced strategies, they do have risk, right?
Yeah.
And it is a form of debt reduction where you're actually selling down properties to pay
How do you
down.
find the time to be that active with it all? You
That's
make
all
it.
he did. That's all he did.
That's all he did.
That's all he
all
did.
day, every day.
Yeah.
The operating word there is did.
No, those years were very, very busy years. He was hardly home, and there was a lot of travel, a lot of interstate travel, traveling to areas 2-3 hours away from home.
Yeah.
That was the life.
That was a life.
Yeah, and we don't want people to have that life.
Well, be careful of the life you choose sometimes, right? You
Yeah.
know, because once these things can snowball, right? You know?
Yeah, just remember investing in the background, lifestyle in the
Yeah.
forefront.
Have you have you lost many times on those sort of buy and flip type things,
No.
or you normally win?
No, not always win.
You
Always
win.
How do you always win?
We make sure you do the numbers, worst case scenario up front.
Yeah, okay.
Yeah, can't go wrong from there. If you already catered for the worst case scenario, and this is true with when I'm talking to clients about buying property as well, starting up their portfolio, we address the worst case scenario first, and then everything's easy from there. If you're prepared for the absolute worst case, can't go any worse than that.
Yeah, but so you never had something which is really just scuppered you. You can't plan for everything.
No.
There's always
Yeah,
something
we had one problem, like early in the days when we didn't kind of know what we were doing, and that was those unregistered land.
Oh yeah. So yep. So
that
we speculated way
like,
back.
Oh my gosh, that was
Unregistered land.
Unregistered land that we bought on option, and they registered it too early, but we managed to wriggle out of the contract.
Okay.
Yeah, so that could have gone.
Yeah, that could have gone pear.
So this is a blood sport sometimes. Property.
It can be.
What there was something you mentioned before, and I thought, you know what, we all talk about all the good things, all the good strategies, and how all of this, because there's just so much of the positive stuff out there that people are doing and talking about, that people don't actually get to know the real negatives that go on as well.
There's heaps.
So there's heaps, but that's the thing, because it's been all glossed over all the time.
Yeah, that's one of the reasons why we started doing this sort of stuff, right?
right.
Because let's talk about it, you get it wrong.
Yeah.
Like you know, it sounds like you always win. You know,
Except for myself and the bay.
It wasn't always like that. I mean, we lost a bit of money as well in the beginning, which is one of those that where we had to kind of, when we got out of the contract, we had to kind of pay to get out of the contract.
Yeah.
So yeah, that's the reality. That's
as long as you win more, you lose. You're
Yeah.
sort of typically
That's
ahead of things. But that's really good. So sedate sort of strategy, build and balance strategy, and a generational strategy. So yeah, you do graduate into. You don't
Yes.
start at the end.
Don't start
Yeah.
at the top end.
So coming here, I was saying to Victor, like, we know these are all the strategies, right? And so if someone's got all this money and they don't want to sedate and, come to grow themselves into this, why couldn't they just jump in? I've got all this money, I want to go here. So yeah, that's a question, right? Someone might say, well, if you guys know all these things, why don't you put me straight into something like this? What's the answer?
Well, you got to learn how to handle the property manager, the debt, the decision making. So at least do one buy and hold first before you graduate into anything else.
And I think that's important. I still enjoy learning new skills. You know, I think it's great. And if you haven't done property investment before, you've got to learn. You've got to start somewhere, and you're not going to be an expert straight away. So one buy and hold and get used to it and deal with the problems and be comfortable with it and understand. Like you sort of forget, but buying a first property for a lot of people is very stressful, right? Like they go, well, I've got to exchange, and then I've got to wait 10 days, and I've got to work it out. And what if this happens and this happens? What happens if there's termites? What happens if this is
Don't
this?
worry,
and
Michelle will handle that.
And then everyone around in a circle says, oh no, you shouldn't have bought in that area.
You shouldn't have, it's the worst place ever. Why'd you buy there? You're an idiot. Like it's everything around it. So, so irrespective of where people are, though, you can help them.
Yes. Yep. Even if you've got an established portfolio.
Probably where you have most help needed.
Yep.
Yeah. So what's the best way to track you guys down?
So jump onto our website, rightpropertygroup.com.au, or like I said the last time, do it the old-fashioned way, 1300 302 166.
Brilliant. That's how you do it. Call up someone, have a chat with them. Have a chat with them. That's good. I really enjoyed that, gang. What's next on the agenda for our build design your decade?
We might dial a bit more into more of the nuances of strategies and the negative side of it.
Okay. I like being negative.
Negative Nelly he is.
It's where I do my best work. Rightpropertygroup.com, there you go and track down the crew there. And typically you'll have a chat with one of your team members.
Correct.
Right, before. Yep. Yeah, okay. But go and do that. Find them, got the phone number there. And that's it. That's it from us for this is our 6th installment of Design Your Decade, special series we're doing to help you shape your property investment journey. Thanks for tuning in. We'll see you next time. Until then, bye-bye.